Bitcoin is in much better shape than it was just a few days ago, and according to some analysts, it could continue climbing toward the long-awaited $100,000 mark. But what exactly needs to happen for BTC to get there? Stay with us to find out. We will also discuss the explosion in XRP's network activity, ZCASH's historic achievement, and the recent problems faced by the major crypto exchange KRAKEN. Finally, we will tell you how an American businessman who stole nearly $25 million from unsuspecting victims through his crypto scheme could be sentenced to 280 years in prison. It is great to be together again. If you enjoy what we do, support us in the usual ways. Leave a like and a comment, and most importantly, subscribe to our channel and turn on the notification bell. It is completely free, takes only a few seconds, and helps us tremendously. Today, the crypto market appears to be catching its breath after its rapid ascent over the past few days, with Bitcoin slipping slightly to around $79,000. Ethereum has fallen back below 2,500, while altcoins such as Pepe, Trump, Stellar, Polkadot, Cardano and Shiba Inu have recorded daily declines of approximately 7 to 8%. But the whole thing seems perfectly normal after all. The market cannot keep exploding higher every single day. The sector's total market capitalization remains above 2.7 trillion, something we could only have dreamed of at this time last week. We begin the main part of today's episode with Bitcoin because, despite today's small step backward, analysts at CryptoQuant believe the leading cryptocurrency has already entered the initial phases of a new bull market. The reason is the approximately 24% rally over the past few days, which has pushed several important indicators into bullish territory. The so-called Bitcoin bull score jumped from just 30 to 80 points in a single week, reaching its highest level since October last year. 8 of the 10 indicators included in the index are now flashing bullish signals. The rally has also been supported by strong spot market demand. For the first time since early October 2025, spot and futures demand are increasing simultaneously. Before we start planning the $100,000 party, however, Bitcoin must overcome one extremely important obstacle. According to CryptoQuant, BTC needs to secure a weekly close above its 365-day moving average, which currently sits at approximately 83,000. The May high of 82,820 is located almost exactly in the same area. A decisive breakout above this zone could support the argument that the major bottom is already behind us. It could then shift attention first toward 100,000 and eventually toward Bitcoin's all-time high. In other words, 83K has become the final boss of the current recovery. There are still several reasons to remain cautious. Traders' unrealized profit margin has reached 20.5%, its highest level since June last year. The last time it climbed to a similar level, Bitcoin subsequently crashed by approximately 30%. Whales have also started taking profits. Between August 20th and August 22nd alone, large short-term holders realized approximately $1.2 billion in gains. At the same time, around 53,000 BTC were transferred to exchanges, the largest inflow since June. The overall picture is therefore considerably more positive, but we are still missing definitive confirmation. Bitcoin must do more than briefly touch 83,000. It needs to finish the week above that threshold. Only then can we begin looking more confidently toward the long-awaited $100,000 mark. Moving on to XRP, which ranked among the best performing major altcoins over the past week and briefly reached $1.76 before falling back toward its current price of approximately $1.45. The price rally, however, is far from the only interesting development surrounding Ripple's token. In just a few days, the number of active addresses on the network exploded from slightly more than 47,000 to approximately 356,000. That represents an enormous 655% increase and shows a dramatic surge in user activity. An explosion of this magnitude usually indicates stronger participation and is often accompanied by significant price volatility. We should still clarify that higher network activity does not automatically mean all these people are buying XRP. Some may be selling, while others could simply be transferring their funds. Regarding the price, analyst Cassie Trades believes the first potential target sits at approximately $1.78. That could be followed by a pullback toward $1.30 before another possible attack on $2.57. If the entire projected scenario plays out, XRP could eventually reach as high as $2.90. Before we start dreaming about such prices, however, there is a much closer and more important level to watch: $1.55. XRP recently overcame 7 months of resistance, rallying approximately 70% in a single weekly candle. According to analyst Crypto Patel, holding above $1.55 could set the stage for the next move higher, while falling below that threshold would increase the probability of a deeper correction. Additional support is coming from US spot XRP ETFs, which continue to attract millions of dollars. The combination of stronger network activity, ETF demand, and a breakout above multi-month resistance looks promising, but we will have to wait and see what happens next with Ripple's token. Moving on to a historic achievement for ZCASH, as the world's first exchange-traded product offering direct spot exposure to ZEC has begun trading on the NYSE Arca exchange in the United States. The product was launched by Grayscale and trades under the ticker ZCASH. This is not actually an entirely new fund. Instead, it represents the conversion of the existing Grayscale ZCASH trust, which launched several years ago. The major difference is that investors can now gain exposure to ZEC through a regular brokerage account without having to purchase and store the cryptocurrency themselves. The new structure also allows shares to be continuously created and redeemed. The old trust occasionally traded at enormous deviations from the value of its underlying assets, sometimes at a premium of more than 200% and other times at a discount exceeding 50%. In simple terms, investors were not betting solely on ZCASH. They were also betting on whether the trust itself would behave normally. At launch, the fund held more than $300 million in assets. Coinbase will custody the ZEC tokens, while Jane Street and Virtu will participate in the share creation and redemption process. There is one detail, however, that certainly will not appeal to everyone. The annual sponsor fee is a hefty 2.5%. That is many times higher than the fees charged by most spot Bitcoin and Ethereum ETFs. According to Grayscale, the revenue will be directed back into the ZCASH ecosystem to support network development and marketing. The news is important not only for ZEC but also for privacy-focused cryptocurrencies as a whole. These assets have faced regulatory pressure and exchange delistings for years. Now, one of them has reached the traditional US stock market. However, ZEC's price had already risen considerably ahead of the launch, so we are yet to find out whether actual demand for the product will justify the excitement surrounding its debut. We continue with KRAKEN and a rather unusual incident showing that in crypto you can sometimes run into trouble not only by sending funds to the wrong place, but also by receiving money you never asked for. The exchange temporarily restricted access to some customers' accounts after they received small crypto transfers from wallets linked to the sanctioned HTX platform. Between August 17 and August 24, approximately 12,000 transfers were sent to KRAKEN addresses, with most worth anywhere from a few cents to several dollars. KRAKEN described the incident as a dust attack. Such attacks normally involve sending tiny amounts of cryptocurrency to a large number of addresses to track their subsequent movements or create other problems for their owners. In this case, the transfers triggered KRAKEN sanctions screening systems. As a result, some customers were automatically flagged and temporarily lost access to their accounts, despite never requesting or approving the funds. The exchange has now reviewed the cases and restored access for the affected users. However, it continues to freeze the funds linked to the sanctioned wallets. KRAKEN suspects the transfers may have been an attempt to spread sanctioned assets across other platforms and undermine confidence in their compliance systems. HTX, however, firmly denied organizing the campaign and suggested that individual users may have been responsible. For now, there is no definitive confirmation of who actually ordered all 12,000 transfers. The incident exposes a rather unpleasant weakness. On a public blockchain, nobody can stop you from sending tokens to someone else's address. But if every unsolicited transfer from a high-risk wallet results in an automatic account restriction, that system could easily be weaponized against innocent users. We finish with American businessman Brent Cover, who promised crypto investors fixed annual returns of between 15% and 30%, accompanied by a 100% money-back guarantee. As you can probably imagine, when someone puts 30% profit and full guarantee in the same sentence, the story rarely ends well. Cover operated the Las Vegas-based company Profit Connect from late 2017 to July 2021. He claimed to use artificial intelligence and a supercomputer to mine cryptocurrencies and verify transactions. He also assured customers that the company held hundreds of millions of dollars in crypto reserves and that their investments were insured by the US Federal Deposit Insurance Corporation, better known as the FDIC. According to prosecutors, it was all one enormous fraud. Profit Connect was not profitable, did not possess the advertised reserves, and had no legitimate way of generating the promised returns or providing the guaranteed refunds. Instead, money from new investors was used to keep the company running and make payments to earlier clients, creating the illusion that the returns came from its crypto operations. Kovar also spent part of the funds on gifts for employees and the purchases of his own house. At least 400 investors were defrauded of approximately $24 million through the scheme. Following a 9-day trial, a jury convicted Kovar on 15 charges including wire fraud, mail fraud and money laundering. He is scheduled to be sentenced on November 30th and faces a combined statutory maximum of an astonishing 280 years behind bars. That does not necessarily mean he will actually receive such a lengthy sentence, but it certainly demonstrates the seriousness of the charges. For everyone else, the familiar lesson remains. When enormous returns are presented as completely guaranteed, the only thing that is actually guaranteed is the risk of losing your money. That is where we leave you today, folks. Remember to support us however you prefer if you found the episode useful and interesting. We will see you again tomorrow. Bye.